G'day taxpayers, RBA cut 25, and gee, a lot of issues in the statement give me pause for thought that something more than that was certainly on the agenda. We'll hear from the RBA Governor, Michelle Bullock, in a short while with her Q&A session for the media. But the things that hit me about this statement and how actually dovish it is, and there's more rate cuts to come clearly, is that they see downside risks to consumer spending. That was one area where they were banking on the economy to be stronger through the next year or two, and it clearly hasn't materialised. The household spending indicator has been really soggy, really weak. Retail sales have been really weak. Consumer sentiment's been weak. And so all of the indicators that normally drive household consumption are not doing what the RBA thought it was going to be doing. And interestingly, there's a couple of other more really pertinent points from the RBA statement that I think are worth highlighting really loud and clear. Last month, they noted that there were sort of balanced risks on inflation. It could go up, it could go down. Remember, they were actually sort of signalling that they could be seeing higher inflation in the period ahead. Now they have concluded, quote, the risks to inflation have become more balanced. Upside risks appear to have diminished. So that fear that inflation is going to go back anywhere near 3% is certainly been washed down the drain, and that's good news. And even with the rate cut today, they say that monetary policy is, quote, somewhat less restrictive. So monetary policy is still imparting a Python squeeze on the economy. The 3.85% cash rate is still going to see economic growth weaker, employment growth weaker, unemployment rate higher, and the inflation rate lower because monetary policy is restrictive. And as I've been banging on about for a little while, we've got to get monetary policy back towards that neutral level, which is somewhere in that 3 to 3.25% range. So that's why I thought they'd go 50, and we'll see what the governor says. As I noted, that maybe 50 was on the table, but cooler heads prevailed for now. And the other thing that's really, really interesting when it comes to the Trump tariff effects and the Chinese retaliation and the European retaliation and that whole shit show that's going on in the global economy and the US policy settings, quote, the board considered a severe downside scenario to the economy and noted that monetary policy is well placed to respond decisively to international developments if they were to have a material impact on activity and inflation in Australia. So they're going to be poised to be slashing rates if, as we saw with the Liberation Day debacle from Trump, that turns in to a really weak scenario. And just by the way, the Chinese also eased monetary policy earlier today. China's trying to fight deflation, and if that's happening in our major export market and one of the dominant economies in the global economy, things are looking pretty grim. So more rate cuts to come, but at least they did 25. Better than a poke in the eye with a burnt stick.
So as you know, today the board decided to cut the cash rate by 25 basis points, and that takes the official rate to 3.85%. Now we've done this because the most recent quarterly CPI confirmed that both headline and underlying inflation are now under 3%. And if you ignore the more volatile items in the headline CPI, our forecasts see the underlying pulse of inflation around the midpoint of the 2 to 3% range over the next year or so. So price increases have slowed, and it's fairly broadly based, and this is very good news. The board's strategy over quite some time has been to bring inflation down while avoiding a sharp rise in unemployment. This is consistent with our dual mandate of price stability and full employment. I know this period of relatively high interest rates has been and continues to be challenging for many households and businesses, but it was essential we brought inflation down because inflation hurts everyone.